Tato. Good morning, everyone, and thank you for taking the time to join us today. I'm Namrata Hadley, Business Manager at Auckland Business. Our fourth Expert Talks webinar with Kiwi Bank economists Jarrod Kerr and Mary Jo Vergara, who will share their latest economic updates. Jarrod has been Kiwi Bank's chief economist for over 3 years now, and prior to that spent 16 years overseas working in banking and finance in Australia and Asia. He has a master's degree in applied economics and finance, and he's a keen tramper and conservationist. Mary Jo has a keen interest in how the Kiwi economy fits into the global landscape. Her research ranges from macroeconomics to environmental economics to New Zealand economic history. Before joining Kiwi Bank, Mary Jo began as a research analyst at an economic consulting firm in Auckland's North Shore. Mary Jo holds a master's in economics from the University of Auckland. With everything that has happened this year, we are all still living with a lot of uncertainty, so I'm sure you will have lots of questions. Please ask them. You can do so by typing them into the Q&A function of the application, and Jarrod and Mary Jo will answer them at the end of their talk. We hope you get some valuable insights from this webinar today. Thank you again for being here, and I will hand over to you, Jarrod.
Kia ora, and thank you all for joining our call this morning. We're going to talk to you a little bit about the New Zealand economy, the outlook, how we see things faring in the next couple of years. And then we're really keen to get your questions at the end. We actually get a lot of information from the questions that you ask, and we'll do our best to answer and get on top of whatever issue it is that's burning at your end. Now, I'm going to start off with our title for the economic presentation, and that is Highly Uncertain Times, Highly Uncertain Measures. And I think that title could be applied to any economy around the world at the moment. We've gone through something which we haven't seen before, and the closest thing to what we've just gone through is either wartime or the Spanish flu of early in the 1900s. So we really are in unprecedented times. What's interesting is that central banks and governments are throwing everything at it. So we're seeing some really interesting responses. What we've noticed is that the New Zealand economy in particular has been incredibly resilient, and I think we always underestimate the adaptability of business. We always underestimate the resilience of ourselves, and what we've seen quite clearly in the last 6 months is that Kiwi businesses are adapting. They're adapting very quickly, and with each lockdown or with each disruption in activity, we're becoming more resilient to it. So the Auckland lockdown had much less of an impact than we thought. Even the first lockdown had less of an impact than we thought. We just adapted, and we'll continue to adapt. And there seems to be some good news on the horizon as well with regards to vaccines and how we may potentially end up living with the virus. Speaking of the virus, you've all seen maps like this that show the explosion in bubbles around the world, and with over 54 million cases around the world and over 1.3 million deaths, the pandemic really is still alive and spreading rapidly. What that means from a Kiwi's perspective is that our pristine little bubble in that bottom right hand corner will want to remain that way. I think the election outcome, which was obviously a clear landslide win for Labour, supports the policies that have been done to date. So it was a real vote of confidence on the reaction to COVID-19, the management of COVID-19, and I don't think it's much point arguing either way. We've gone for an elimination strategy, and that's the strategy we're going to stick with. So in pursuing an elimination strategy, we're still going to be quite cautious in opening up our borders. Of course, vaccines will ultimately change that, but in the near term, at least over the next year, I think we will only ever slowly increase our borders and at a rate that we can handle in quarantine. So there is a significant part of our economy that will continue to do it very tough, and that's tourism. But looking at our trading partners, I mean, New Zealand's one of the best performing economies in the world right now because we've had that elimination strategy. We've been very successful in managing the virus compared to other countries where it's just running through. The impact on the global economy is staggering. We've seen a huge contraction in output, and it's going to take a long time for that economic output to return to where it was, but then also get back to levels of full employment. And New Zealand's still facing those closed borders. You can see short-term arrivals, long-term arrivals, departures all falling towards zero. That's not good for us. We are a small open economy that has a large export sector, a large tourism sector, and we're going through probably the hardest time on the tourism front over the next few months. The summer period is going to be particularly difficult for New Zealand tourism operators. We had a really good winter, just quietly. The winter period we've just been through has been fantastic because Kiwis didn't leave. Kiwis stayed here and travelled around the country. So we got more of an offset to the lack of international tourism by Kiwis staying at home. Now, every Kiwi could take a holiday over summer, and that probably wouldn't offset what we would normally get from international flows coming in. That's because this is our peak season, and we can't offset that. So there is going to be a tough 3 or 4 months ahead for regions affected by the drop in international tourism. Having said that, we are bouncing back. We will see a big surge in output in the quarter we've just finished, the third quarter. We had a 12% reduction in the second quarter. We'll have a 10% increase in the third quarter, and then the fourth quarter and the first quarter of next year will probably be a little soft, and then hopefully we start seeing our growth rate accelerating into 2022. And as you can see on this chart here, that V-shaped recovery is pretty awkward looking. We've had that drop down, we're bouncing back, and then we'll take a few years to get back to where we were. And we don't think that we will get back to full employment for another 3 years, and that's a long time. Putting that in terms of displaced workers, people who have been made redundant, the outlook is simply much better than what we thought. When we first put our forecast together during the first lockdown, we thought that unemployment was going to spike as high as 9–10%. Actually, what's happened is, with the aid of some really good policies, including the wage subsidy, we haven't seen as much of a spike in unemployment. And this is a very good news story. So our unemployment rate's likely to lift from around 4% to around 6.5%, and we're pretty much halfway there. We're currently at about 5.3% at the moment. And if you think in terms of an economist's mindset, saying that we're going from 4 to 10% and then pulling that back to 6 and a bit, that's a big change in our thinking. We had thought that lift to 10% was going to cause a lot more damage, would raise a lot more defaults at banks, and therefore see house prices come off. That doesn't look like that's the case. It actually looks like we're going to be a lot more resilient and have a lot less economic scarring than previously thought. What does that mean for inflation? Well, inflation's heading towards zero at the moment. We've got a strong currency. The prices that we import from overseas are weak already, and then they face a stronger Kiwi currency and get even weaker by the time they land on our shores. So we see some disinflationary pressure coming from overseas. And then internally, our inflation is softer as well. We've seen rent freezes, we've seen wages growth ease, general inflation in the economy's weaker. And that is perfectly normal. That is exactly what happens during a recession. So we will see inflation drop into next year towards zero, but hopefully there's enough stimulus in the economy that will turn around and you'll start to see prices stabilize and hopefully get back towards 2% over the next 3 years. But with unemployment heading in the wrong direction, even though it's not going as far as we'd feared, it's heading in the wrong direction. And of course, inflation heading in the wrong direction, heading towards zero rather than 2. As a central bank, your 2 mandates have not been met. And if anything, they are moving away from where you want them to be. And that's why we've seen the central bank and the government come up with a whole range of policies to try and stimulate us out of here. Government's done a great job in getting infrastructure projects up and running, doing wage subsidies, talking about education and retraining people for the future. More can be done, more will be done. Central Bank has also done a good job in slashing interest rates, providing funding for lending programs to banks, again, to try and lower interest rates, and coming up with quantitative easing programs to make sure that when the government spends all this money, they can access debt markets at ridiculously low interest rates, maybe even negative interest rates next year. Where do we see interest rates going from here, even though they've all been slashed? Well, we see them going a little bit further. We do see interest rates falling further from here, both on the back of the funding for lending program, but also on the back of potentially another rate cut from the RBNZ next year. If things don't plan out as expected, then the central bank has come out clearly stating that they will cut the cash rate to negative to really try and break the back of retail rates and get them down. So try to get mortgage rates under 2%, try to get business lending rates that extra 50, 60 basis points lower than where they are today. The central bank wants to make sure that there's absolutely no issues in credit markets stopping businesses and households doing what they want to do when they want to invest. One thing the central bank's actions have done, and that is boosted house prices. So the whole idea of monetary policy is, in bad times you lower interest rates, it puts money in the back pocket of borrowers so they can then continue to spend. The other, I guess, more contentious way is through the wealth effect, and that is you make asset prices higher, and that's exactly what they've done. Asset prices have gone higher. Obviously that benefits the owners of the assets rather than those who don't own the assets. But the idea there is you'd rather have house prices being up 10% than down 10%, and that's their justification. We are at a point though where house prices have risen 13% so far this year and look like will continue to rise at double-digit rates into next year. But the counterfactual, as we've shown on this chart here, our previous forecast was for a correction in house prices. Now it looks like we're going to get a pretty good run at it, and for a little while yet. So to go through the detail on housing, but then also look at some of the exciting data that we've got internally, I'm going to hand over to Mary Jo.
Yeah, so the housing market. Activity in the housing market has been incredibly surprising to date. The latest, hopefully you can see this all, and there's a few factors that are sort of driving the activity in the housing market. But to catch up on all that stuff that's happened, like what Jarrod said, we've seen that the latest data has shown that house prices are running at double-digit rates. They're up 14% on the year, which is astounding, and it's something that none of us were expecting at all going into this, into the lockdown. During the lockdown, we were all expecting unemployment to rise and prices to fall, and house prices to fall because of it. But it seems that the housing market has just gone from strength to strength, completely defying all expectation. And a large part of this is due to the cost of leveraging. So mortgage rates, they're currently at record lows, and they'll likely fall even further. And it's in this, with interest rates so low, it's in this low yield environment that when you're getting sort of next to nothing when you put your money in the banks, that people are turning and piling into property in search for higher return. So rental yields are looking increasingly attractive to investors. Rental yields are sort of 3 to 5% in some regions. So when you're comparing that to a rate you'll get from a term deposit or your savings rate, it's kind of a no-brainer where you want to put your money in. And that's partly the idea behind expansionary monetary policy. It's to push people out the risk spectrum, to get people to invest and to get people to spend. And it says that, as Jarrod says, that wealth effect, that you kind of get this stimulatory effect on the economy to kind of sort of boost the economy. But by lowering interest rates, we've seen that boost in asset prices, but that boost in asset prices has largely been concentrated in housing. So house prices, as these graphs shown, has just skyrocketed. And it's a phenomenon that's sweeping the entire nation. It's not just Auckland recording double-digit rates or Wellington. Most regions are experiencing double-digit house price growth. And even down south, where these are regions reliant on foreign tourism. And so you'd think that with this lack of foreign tourism right now, that you'd see an ease in demand there, and then prices would fall. But that's just not been the case. We've seen house prices there following the trend in all other regions in the country just accelerating. And so, as I've said, this flurry in activity largely boils down to mortgage rates, where they're currently sitting. They'll stay low for some time, and they'll likely fall even further, especially with this new funding for lending program that the Reserve Bank has just recently introduced. The idea there is to lower the cost of funding for banks to enable them to lower lending rates like mortgage rates even further. So it's hard to picture a scenario in the future where interest rates would rise from here in the next 3 to 5 years. And I think throughout this pandemic, what it's shown in the monetary policy to date, what it's shown is that the power of interest rates on the housing market. You kind of have the supply of housing, which has been practically constant, and that's another reason why we've seen such aggressive house price growth. But really the only variable here has been interest rates, and that movement lower has seen the demand for housing just strengthen, and prices have risen because of it. So this pandemic has sort of exposed the vulnerability of the housing market to interest rates. And of course, adding to this market pressure has been the removal of the loan-to-value ratio restrictions. Initially, they were removed in May of this year to enable those people, to help those people access the mortgage deferral scheme who might have been bumping up against their ratios. But at the same time, it's enabled people to leverage up a little bit more, look into investment properties, but also for those to enter the market, to get their foot on the property ladder, the market that's been largely closed off to them in the past and up until now. And so it's among these investors and first home buyers that we've seen a lot of the action driving in the housing market. So they've been particularly active. In fact, coming out of lockdown, a lot of the lending that banks were doing were to these groups, and it's just accelerated. They've taken advantage of this current sort of relaxed environment. But these restrictions, these loan-to-value restrictions, are coming back, and that should sort of limit the lending that banks are doing to these higher risk groups. Now, that tightening in bank lending standards should begin pretty soon in sort of anticipation of March. So they're coming back in March, which is about 2 months ahead of schedule. But given the way that banks sort of offer these 90-day pre-approved loans, that sort of bank tightening in standards should begin. Now, the reinstatement of this macroprudential tool should help to calm the housing market a little. And hopefully that calming in the housing market will sort of see lending be redirected to other sectors of the economy, particularly into business. The challenge, of course, is in trying to bolster the demand for credit among businesses, which has been lacking. There's just been no appetite to sort of take on more debt. But recent surveys are showing that there's the lift in confidence is returning. So we have mortgage rates. They're arguably the main driver of activity in the housing market. But the market is also supported by this long-standing issue of a shortage of dwellings across the nation. We have such short supply, but all this demand, prices have risen, and that's exactly what we're seeing in the housing market. So as much as we like to call this a demand issue that we're seeing in the housing market, it's just as much a supply issue. We're just sort of lacking in that department, and that's a huge reason why we've seen prices rise so aggressively. Now, looking ahead, prices will be elevated, but later on next year, we may see that sort of ease back a little. For starters, you've got migration flows, which are falling fast. Previously, they've been a key driver of demand, but with our closed border situation continuing, those flows will start to fall or have already begun falling. There's also that expectation of unemployment to rise further, and the reinstatement of loan-to-value ratios. So these three factors will likely weigh on the housing market, and house price growth should ease through to 2021. Now, just to wrap up, I thought I'd touch briefly on our proprietary spending data and the patterns we're seeing emerge. Traditional economic data, it's released with a considerable delay. GDP numbers, for example, come out 3 months after the quarter's ended. So it's data like this that's high frequency, that's highly informative, that sort of lets us stay 2 steps ahead. We get a feel for the economy in real time. And the pattern in spending has been as you'd expect. You sort of saw a plunge in spending going into lockdown, then a flat line in spending practically everywhere except for food and supermarkets, but then a spike back up as that release of pent-up demand when we came out of lockdown. So that sort of pattern was expected, but what we've been surprised by is the strength of this bounce back, and also the persistence of spending coming now, a couple months after coming out of lockdown. And the spending just remains high above pre-COVID levels. And that's despite the lockdown that Auckland faced back in August. It appears, I guess the biggest takeaway is that households and businesses have just been adjusting to this reality of living through alert levels, having to move in and out of it. In fact, businesses have been able to rejig their models to accommodate things like social distancing and in particular the move to digital. This move to online, this move to digitization and automation was already happening before COVID came. What COVID's done and the need to lock down economies has just been to accelerate this move. But it's not just businesses that are adapting. We are too, with this whole trend of working from home. For some of us, this move has been pretty easy. It's been smooth. I mean, I guess since the rise of the internet, we've been able to communicate via electronic means, through email and things like that, without actually realizing or sort of taking advantage of the fact that we don't have to be in the same room. But with COVID and the need to lock down economies again, it's sort of created this global experiment in remote working. And for some of us, it's sticking. More offices are adopting sort of flexible working practices. But it does sort of hold implications for the future of office space and commercial property. Does a typical office have less cubicles and is more of a space for collaboration? But regardless, what these charts show is that this trend for working from home and our demand for things like online services, things like Teams and Skype and Zoom, it's just grown. So it does sort of throw up some questions about the future for commercial property. But consumer spending throughout has fared much better than we were expecting back at the beginning of this pandemic. And one area where we've seen spending surge has been in DIY and home renovations. It's likely that with our holidays, overseas holidays cancelled, that spending has sort of been redirected toward the home. And again, this move to working from home may have prompted some of us to revamp the home office, buy an office chair, redo the paint, redo the walls. So it's all this sort of redirection toward the homes that we've seen coming out of lockdown and persisting. Now we're also seeing a change in habits. During lockdown, we could only spend on things like food. So we've seen that spending on fruit and veggies and this healthy alternative continue even after lockdown. The shopping online, our entertainment that we're getting online, that's all sort of becoming entrenched. And also this move away from cash we've seen develop. So all these change in habits that we've seen develop during lockdown has sort of become entrenched, looking at how spending's continued. So this data, it does sort of give us some signs about what to expect. What this data is also showing is that it's sending warning signs about the times ahead. It's great that many businesses have been able to adapt to this online platform of trading. But the reality is that not every business is able to do so. So this move in and out of lockdowns and this move up and down the alert levels, it continues to have a disproportionate impact on traditional retail services, those that sort of can't conduct their business online. So we've sort of seen this impact, this unevenness across the economy. Some are proving to be really resilient to lockdowns, but some are still suffering from the limited contact. And one sector in particular is the tourism sector. So as Jarrod said, the tourism sector had a record-breaking winter. They've had record-breaking visitorships with all of us sort of going down to Queenstown, and they've just been recording some good visits. But there's concern as we head into the summer season. It's a time when foreign tourism is typically strong, and so you might see a rise in domestic tourism, but that will unlikely be enough to sort of fill the void left by international tourists. And that's the thing, our recovery, it's building momentum, it's taking shape, but no recovery is guaranteed so long as the pandemic continues and restrictions like our border controls and social distancing have to also continue. In fact, the worst thing policymakers can do right now, particularly from the fiscal side, is to slow down and withdraw any support. It's largely because of their actions and the responses to date that we are in this fortunate position to say that the outlook is less doom and gloom than we had initially feared back in April. But our recovery is inextricably tied to the pandemic. And that latest community case outbreak, which thankfully looks to be contained, is sort of a reminder of that. It's a reminder that there are still risks ahead. But the good news is the government, they've acted prudently up until now, and they still have ample capacity to keep going, to keep supporting the economy and sort of ensure a secure and confident recovery from this. That's all I've got. I'll hand it back to you, Namrata.
So thank you very much, Mary Jo and Jarrod, for that. That was awesome. We do have a couple of questions that have come through. So the first one is from Anonymous, and it just asks, the most affected by unemployment were women and young people, which the government are trying to retrain into the building/trades industry. However, I'm not seeing that. I'm seeing a lot of women starting their own businesses. Do you have any data on the apprenticeship numbers and some analysis on who are taking up these apprenticeships? I feel there are a few people falling through the cracks now in terms of government support.
Good question. I think so that package deal I think you're alluding to there is it's a trades and training package. So it's to sort of encourage more people into training. The thing is though, it's not a common route for young female students to take vocational training. The sort of preferred route is the university route. What I'm hoping from this package is that it kind of encourages more women, because it's sort of I think the way it works is that it's a free training session. It sort of subsidizes training expenses. So I'd like that sort of to encourage some young women, but I'm not sure about the number of apprenticeships, but I imagine it's quite low, given that that's not a typical route that young female students take. So that rise in self-employment, I think that's all kind of reflective of the route that women usually take when they're working in the labour market.
But it's a good point though, MJ. I mean, how many women have lost their jobs during this? Why? And what is a better solution?
It's been a staggering amount. So since March, about 70% of all those who had lost their jobs were women, and it's largely because of where they're concentrated in the labour market, which is in the services and the retail sector. And because of the lockdown, those businesses have had to close down, and we've just seen the number of women unemployed rise because of it. So it's difficult. Another reason why you might not see a large uptake in women in that training package is because it's difficult for a female barista to become a female tradie. It's kind of, they're quite different occupations and different training skills. So some of the investment that the government can do is to target sort of health and education, and that solves a problem in that most women are in those sectors. So helping to expand resources in that sector will not only boost the economy through that investment, but also help to secure women's employment there, and also provide some opportunities for women to enter health and education.
Yeah, I think one of the answers is actually in the question. You know, I'm seeing a lot of women starting up their own business. I think the more and more we can do as an economy to foster entrepreneurial spirit, to foster small to medium, enterprise, whether it's grants to SMEs or some sort of package to help you set up a business is probably the most important here. And those that get displaced, men or women, but in this case, mostly women, would have access to something to build their own creation. I think that's probably the another part that could be added to the package. Do we have any other questions out there?
Yes, we've got another question there. So this one's just come through via text. It's come through from Ben. Are you concerned with the current level of stimulus and the long-term forecasted low interest rates that we risk entering into an economic environment similar to that of Japan during the 90s and 2000s? And by that, I mean a zombie-like economy with little real economic growth.
Excellent question, and I'm glad we've got 3 hours for me to answer it, because there's a few things to cover. No, it's probably the biggest challenge of my career was trying to figure all of this out. And when I first started, I started at JP Morgan, and I was talking to a Japanese economist over there, and I was saying, what the hell's going on? He said, oh, Japan's just like a Western country, except everything's upside down. I was like, well, that doesn't help me much at all. And then he explained the fact that they've got this aging population, and with an aging population, you have this surge of savings, basically. Not enough investors, too many savers. So if you think of the demand supply curve, you've increased your supply of money and you're decreasing the demand. So the price, which is the interest rate, heads south. And theirs have gone negative, and they've had periods of deflation as well. Most of that is attributed to demographics. They in 1950, 80% of their population was aged under 30 or something like that after a war, and you know how the war ended. Fast forward to 2030, 65% of their population will be over the age of 50. Like, they've got a very, very old population. So that has been a big downward shift. That is a downward shift that's been put on all economies now. Some are better than others. We're better than others because we import people. When you import someone, they generally age between 20 to 40 and they fill the gap. But yes, the main point is interest rates have been falling, and I think will stay low for a very, very long time. Now, what debt do we have as a country? We've got private debt, which is distributed by banks and held by households. We've got too much of that. We've got public debt, which is debt issued by the government to do stuff that government should do. We don't have enough of that. We had 20% of GDP prior to the crisis. We're heading to a situation where we'll have 50% of GDP. Every developed country on the world would love to start at 50%. They'd love to start at our ending point. United States is starting in the 70s. So is Germany. So is all those other highly rated countries. So we have oodles of capacity to do what we're doing today and a lot more to get us out. And there's two ways you can pay that debt back. You can build a more productive, skillful economy for tomorrow and end up with a larger tax base, pays itself off, lots of real growth, lots of inflation, and debt is no longer your problem. Or we can spray it around. It's a bit useless in what we do. We end up with a whole lot of debt and we end up having a tax. There'll be some sort of bit of both. But then over top of that, we will go into this aging demographic issue, and I think we will have to have some serious discussions about pushing out retirement ages and doing what we can to better balance the book down the road. But right here, right now, I think we should be spending, and we should be spending more than what was currently being proposed to build ourselves a better economy, more productive economy for tomorrow.
Awesome, thanks, Jarrod. The next question we had was, are we seeing a discount in commercial property lease rates due to vacancies?
We're getting some mixed pictures across commercial. We hear there are some parts and pockets of cities, CBDs, that we're seeing some of that pressure. As MJV mentioned before, COVID has got us thinking a lot more about doing this, working from home, reducing office sizes. So I think if there is going to be a correction, it would be within that space over the next 6 to 12 months, and there are some signs there of a little bit of stress, but not a lot. It's nowhere near as bad as what we thought it may be. But yes, I think we are seeing more lease space coming on to the market, both stuff that has been supplied, but also businesses trying to downsize where they can. Rather than having 4 floors, let's try and cram ourselves into 3 and make sure 20% of our workforce is working from home on any given day. So yes, I think that is one casualty of if you like, but I think it'll just rejig the use of the existing stock. It won't become worthless. Another firm will pop in there.
Awesome, thank you. One other question we've got is, so 2 questions in one question. It says, if New Zealand goes into another level 3 lockdown, what do you predict will happen with the housing market? And has the RBNZ overstimulated the economy?
I think with that last question, I think there's a lot to be commended by in their least regrets approach. They've done exactly what was sort of needed, stayed on the front foot of this pandemic, and everything they've done has led to the reason why we've been able to have such, the outlook being not as bad as we initially feared. But if we do, there's always that possibility of going into another lockdown with another community outbreak. In terms of what that might mean for the housing economy, it's hard to sort of predict. We've seen, I think, with this, the prices will just continue to rise. What the first lockdown, which is probably the most aggressive, it's shown that the housing market has been really resilient to that. So any Auckland lockdown probably will have little impact on the housing market. It just looks to be going full steam ahead with the current policy environment. It's just not conducive to, it has little strength. It has little impact on, the housing market going any easing back on that.
Awesome, thank you, Mary Jo. We've got another question, and it is, are you concerned that a continued low interest rate environment will exacerbate the wealth gap? Those that have access to debt by way of stable income and current assets, which largely property, will move rapidly upwards, while those without easy access will fall further behind.
Yeah, the wealth gap. It's been quite a highlighted topic with the whole housing market, and that is correct in saying that that might expand people who are leveraged. It's much easier for them to stay leveraged, but for those people who are, the savers, monetary policy is a blunt tool. So those who are saving, it's harder for them to do that, and so that wealth gap will expand with interest rates falling even further. Those who have the owners of the assets, they'll continue to do much better in this low interest rate environment, whereas those who are saving up for the first time or saving up for retirement, it'll be difficult for them to do so.
Yeah, recessions aren't fair at all. So when you have a sharp economic shock, you generally see the lower to middle income earners get adversely affected and hurt the most. So the RBNZ has an issue where you can't let the economy stay in recession because you don't want to fuel house prices. What they deal with is like triage. Let's deal with the patient now, and let's stop the recession, because if we keep the recession for too long, then the widening inequality is going to be even worse through people being unemployed for longer. So let's get them back to work. So what they're working on right now is getting people back to work. And then the next step is, well, okay, we've done that. And in doing that, we've had to take an interest rate from something reasonable to something ridiculous, close to zero. That has now fueled all the assets, and the owners of the assets are clearly benefiting at the expense of those who don't. What's the next step? Well, you do your macro-prudential policy, you do other things to try and rein in that house price appreciation. But everything that I just said is monetary policy. The most useful tool in all of this is fiscal policy. Fiscal policy can actually take a dollar and put it into your back pocket, like not a whole city or suburb. It's so specifically targeted. So you can actually say, right, people earning under this amount, or people who have lost their jobs in this area, here is money to help you. So fiscal policy is much more surgical, like MJV says. Monetary policy is blunt, fiscal policy is surgical. This is why we're putting so much pressure on the government to keep going. You're the ones that have the ability to try and rein in this widening wealth gap.
Awesome, thank you, team. We've probably got time for just one last question, and it is, when do you think the housing rates will drop below 2%?
I think, well, the governor of the Reserve Bank has sort of signalled that he wants to see sub 2% rates, and the funding for lending program, it's sort of, the intention there is to lower lending rates. The take up on that program might be a little slow. It's only going to come out till it's introduced in December, but they've signalled their intent. They're watching the banks closely, that they want to see those lending rates drop below 2%. I guess you have to wait and see.
Well, that's great. Thank you, guys. Thank you, everyone, for joining us today. It's been a great 45 minutes. We hope we've answered the bulk of all your questions. If you've got any further questions that you want asked, please, in the first instance, contact your relationship manager and ask them, and we'll filter them through. But otherwise, this webinar will be up on the Kiwi Bank Business Banking website for you to watch at your convenience. And yeah, contact your relationship manager, contact us via the website if you've got any questions. But thank you so much for joining us, and have a wonderful Thursday.